Start investing in gold and silver at sdbullion.com today and join over 35,000 precious metals investors who have made the switch to the lowest gold and silver prices in the industry. SD Bullion recently claimed a spot on the prestigious Inc. 500, making them one of the fastest growing bullion companies in the United States. With low bullion prices and over-the-top customer service, SD Bullion is setting the standard for precious metals transactions. Visit www.sdbullion.com today. Start saving on every precious metals purchase you make.
This is the SD Weekly Metals and Markets Wrap with your host, Elijah Johnson. Our guest today is silver expert David Morgan. David, thank you so much for joining us today.
Elijah, thanks for having me.
All right, now, over the past week, we've seen gold prices trading in kind of a $20 range. Now, we think over at Silver Doctors here, this either means that gold is going to break out or break down. What is your perspective?
Well, I agree. It's in a trading range. It's overcome, both metals have overcome fairly key resistance at 1250 gold and 1650 silver. But nonetheless, they're just kind of wallowing. The idea that I provide for our members is that not only do you have to go through a key level, you also have to do it on large volume, and the volumes have not been that good. The big move up that we saw recently was due to short covering, not new buying. That's something else to factor in. The COT is very favorable, but very favorable can remain that way for a long time before you get a true breakout.
Now, what is your perspective? You touched a little bit on silver, but did you want to give our viewers a little bit more on your perspective on silver, because it's right around the 50-day moving average, and it seems like we're seeing a healthy dip down right now, and this could possibly mean like higher highs and higher lows. What is your perspective?
Well, from a longer-term perspective, it's very clear to me that we still have established a new uptrend in the bull market, which means if you go back to the low, which is the end of 2015, and you look at that low, and then you look at the next low, it is a higher low. That's on like a monthly chart or a weekly. And that means that we have established a bull market again. However, in present time and what you asked me around the 50-day moving average, again, I let the market determine what's going to happen rather than what I want to happen, which means we need to see a certain level that is sustainable and it is on good volume and it remains at that level for a certain period of time. That's how I do it. That's what I've done for years, and it works rather well. It's not 100% accurate, but it's around 85% accurate. So I'm going to let the market tell me.
So it looks like for both gold and silver, you're seeing that they're in a good, healthy uptrend?
I would say that we're in an undefined range. We're in a trading range right now, and it really hasn't defined. Now, from a longer-term perspective, yes. So I don't want to talk out of both sides of my mouth, but you're basically asking me, or I've answered two questions. One is, are we in is the secular bull market reestablished? The answer to that is clearly yes. And now the other question is, where are we on a short-term basis? And that one is to be determined. But I do believe that we're going to see stronger prices through the end of the year. And I believe we're going to see significant mounting in precious metals pressure to the upside in 2018.
Now, what about the mining sector? Because the second quarter earnings recently came out, and it was kind of mixed. Gold miners seem to be weathering the storm, but silver miners not so much. Can you give us your take on the mining sector right now?
The mining sector is extremely difficult. What we've done is we've isolated companies that make money almost regardless of what happens to metals prices. And those have been really stellar performers. In fact, I just did an interview one-on-one. This was a private conversation with Frank Holmes, and he came out with some new metrics with his new ETF, and we're going to be talking about that in the Morgan Report in a couple of months. But the metrics that he used were basically very interesting because this is kind of intuitively what we've been doing at the Morgan Report for years. So you take one of our stellar ones in the top tier category, that stock, that company is up 600% right now. It basically goes up 20-something% a year over year. Yes, it goes up and down like any commodity or any asset, like a stock or even real estate. The point being is that it's a major trend. This is the kind of investment philosophy I want to, portray to serious investors, because investing should be fun and profitable. And if you want to be in the gold sector, you need to buy the best of the best. I mean, there's a lot of information out there, but are you getting the best information? And this is what people need to know. The problem is, the way I see it, and I am biased, I'll state that right now, is that a lot of people want to, bet the farm or make a bet to make a lot of money in some story stock, something that sounds really good. It's a new discovery. It's new this. Those are extremely difficult to make a lot of money on. In fact, most of the time, the whole newsletter industry focuses on telling a great story about a story, and people buy into that idea. And it becomes kind of a gaming addiction. It's like, well, I lost on that one, but the next one, oh, that one's the best one. So it goes on. Really, the best ones are companies that produce the commodity at a sustainable profit year over year over year. Those are the type of companies we have in our top tier portfolio.
Now, as for the mining sector going forward, it seems like you're saying precious metals themselves are really, for the short term, you're unsure exactly where they're headed, but for the long, they are in a long-term uptrend. So what is your perspective on then where the mining sector is headed long-term?
Far higher, because once we start going into the momentum players and we get, for an example, silver above 20 or 25 even, and gold up to, say, let's say 1,500 or so, then the momentum players will start coming in, and the leverage that's available through the mining sector is tremendously large. So what will happen is that people that manage money and the general public at the tail end of it will come into this sector because there's huge gains to be made, because you get about a 3-to-1 leverage. And especially now with systems like Frank Holmes was outlining, with the quants coming in and doing the analytics on different companies in the sector, you'll see a lot more leverage, and you'll probably see more opportunities through, let's say, ETFs and other derivative products in the gold and silver space. So I'm actually very bullish that the best place to be for balance, I still stress you got to own real metal first. I don't want to, undo that or ever stop that. But if you really want to make large gains and catch up to the people that bought silver at $5 and catch up to the people that bought gold at $300, the only way to do that really is through the mining sector. But again, you've got to do the best of the best. If you're really good at the end of the market, which will probably be in about 3 years or so, 2020 perhaps, there will be so much speculation in that space. You can ride the momentum if you know what you're doing, but a lot of that turns out to be nothing more than a great sales job.
Now, I'd like to move our focus to the dollar. Now, we've seen the dollar index for a while now really getting smashed. It is around 93 right now. What is your perspective on this, and where do you see it going in the near future?
Well, great question. First of all, if you go back and look at my work for years ago, for years, 94 to me was a key level. We've broken down on that. So how far is it going to go down? No one knows, but I think it's going lower. And I want to point out that a lot of people think that the gold price is an inverse of the dollar. And to some extent, that's true. But really, if you study hard, what you realize is the dollar and the stock market and gold are most negatively correlated. So what that means is the reason you're not seeing gold really shoot up here with the dollar really, falling quickly. And people should question that. Wow, the dollar's really down. Why isn't gold doing better? And I actually put that on my Twitter feed, but I digress. I'll come back. It's really inversely correlated to the stock market. What's the stock market doing? It's making new highs. So gold is kind of struggling here, even though it's doing okay. It's not doing as well as it would do if there's a sell-off in the stock market. In fact, there's a possibility of that coming up. The seasonality, as you know, Elijah, is, September, October is usually the seasonality where you get a sell-off in the stock market. I think it has a high potential for that this year. I know I've said that in the past, but I've also tried to say it, straight up, that it doesn't guarantee it, but those months are the ones to be careful of. So this month or this time, we are so overvalued in the stock market. I mean, and I know I've said that for a while. It's been true. It's been true for a very long time. But this could just be the year that we start to see a degradation in the stock market. Time will tell.
Right. I mean, we just saw the Dow break above 22,000, which was a new all-time high. Did you want to tell us a little bit more about your perspective on how overvalued the stock market is?
Well, if you really, and I forget the name of the book, and I think I loaned it out. It's a very expensive book, but I pretty much got it memorized. But it was a very classic as far as how markets really work. And it basically talked about like a low, it talked about an accumulation pattern, which is basically a trading pattern going back and forth in a small range like gold and silver are doing presently. And that takes place over a fairly long period of time. And then you get what's called the markup, which is where that breaks out of that channel formation. It moves up significantly higher. And then you get the distribution pattern, which is another channel formation. It goes up and back, back and forth, up and down within a small range, or another channel formation. And then once the distribution has taken place, then the powers that be that are the insiders or the smart money, or however you want to refer to it, they exit the market and usually short it. So they make money on the way up on the markup. They make money distributing their stock. Once it's distributed and the, let's say, less sophisticated investors are left holding the bag, then they do the mark down, and they make money on the downside as well as they just made on the upside. And then it comes back and builds another accumulation pattern. So we have seen a distribution pattern in the overall equity market, space as the Dow Jones or the S&P 500 or the Russell or any of those that you want to look at, for quite some time. Usually what takes place is after the distribution has been accomplished, then there's usually a further little bitty markup to make everybody feel like they're really smart, that they got in and this new high is really the great place to be. And, stocks are where it's at. And I'm glad I'm out of, the metals and I'm in the stock market and that type of thinking. And so those late players come in and they get a little bit, and then what happens is the powers that be, or again, the sophisticated money, we can call it, decides that's a good place for them to short. So they start building up their short positions, and then all of a sudden you break through that channel to the downside. That gains momentum, and then the selling idea takes over from the buying idea, and now you've got a really strong downward move that, of course, the insiders or the smart money is capitalizing on.
Now, I'd like to focus on how, if the stock market is so high right now, it seems like it should be that the economy is also doing really well, but it doesn't seem so. In our recent report on Silver Doctors, we talked about how the ADP payroll data suggests poor labor market conditions. According to the most recent report, the manufacturing sector shed 4,000 jobs in July. What is your perspective on where the economy is right now, and why is the stock market so high if the economy isn't doing well?
Well, another great question, Elijah. I tell you, this is one that really bothers me. I've been saying it for the last couple of years. And that is that there is no relationship, practically none, between the stock market and the physical economy. If you go back in time, at one point, you had a very high correlation between what the Dow Jones Industrial Average would show you and the physical economy. They basically went hand in hand. If you had a strong Dow and confirmation by the transportation index, you would have a very strong economy. So they reflected each other. But now there's been such a disconnect between what goes on with the manipulation in all the markets, with the trading algorithms that are prevalent, with the quants, which is, again, algorithms or math-based trading, front running by these computers that are sitting just, a few feet off the exchange and that type of thing. All of that is basically nonsense, but it produces a great deal of turnover. So let's drill down a bit deeper. If you look at the United States economy and analyze it from a top-down perspective, what you're going to see is that 70% of the total economy is based on consumption. I mean, this is ridiculous. This is by buying stuff that we don't need with money we don't have, to further the storage facilities to hold the stuff that we really don't want or need. I mean, this is the mentality that we've been given in the consumerism society, or the I got to have more than you idea. It doesn't work, and it's not working, and it's failing. And that's what the physical economy is showing us again and again and again. Look at what retail's doing. Yet the stock market's moving up higher and higher. How can that be? Well, not only do we have 70% of the whole economy based on stuff that you buy, 40% of the market is based on financial instruments that people are trading back and forth. And again, most of the trades aren't made by person to person to better the economy in some way. They're made for some type of idea that you can make money by having money. In other words, it's no physical, productive benefit to society at large whatsoever in any way, shape, or form. It's nothing of the kind. And this is what's taking place again and again and again. So people are thinking they're investing when really what they're doing is they're moving money back and forth. I'll quote, as I have in the past, Elliot Janeway said that at the top of the market, meaning the overall massive perspective to really see what's going on. In other words, with very good clarity, if we get to the point where you and I are sitting across the table from each other, each pushing a life insurance policy to each other, that's the end. In other words, we have a financial product that we keep marking up back and forth to each other, but it really has no meaning in the physical reality that we need. In other words, food, water, productive capacities, systems, and that work for the economy at large. To drill even further, what really moves the economy in the United States for years has been automobiles and real estate. So if you look at what's going on in the automobile sector, it's dying. Yet, if you look at the numbers, they're doing well. Well, how can that be? Well, because the manufacture of an automobile looks great for the GDP. But you see what's called channel stuffing, which means they're producing these automobiles, but they're not selling. Again, on the housing side, it's similar. You're seeing, more construction. You're seeing a markup in the housing sector, again, especially in the richer areas. But this is basically flipping houses or funds that have a massive amount of cash that want to move it into real estate because they don't trust, let's say, the stock market or the commodity market. And again, this is just distorting more and more the actual reality. I mean, the commodities markets, like them or not, are basically on need. I mean, you need coal, you need energy, regardless of the form, whether it's nuclear or it's coal or it's clean or it's green, you need energy. And you need basic raw materials, which means the commodity sector. These are things that you can't live without. And yet this is the market that's been beat up the most. So it's really a good time to think through the big picture and look at where you are allocated in your asset classes and rebalance what you have. Sell stuff that everybody wants now and get into things that people don't want at this point in time.
All right. And it seems like one of those things might be precious metals right now because precious metals have been, beaten down for so many years. And do you think we're at a bottom? I know I've asked you this before. What is do you have an update on that? Like, do you think we're close to a bottom right now?
Yes, we're close enough to the bottom. I mean, an amateur wants to buy the exact bottom, and you can't. I mean, you might get lucky. I mean, I think I've done it twice in my life, and I've done it for 40 years. I mean, I've done it a couple times in a certain small stock, and I've done it a couple times on the commodity sector itself. But you want to buy, any professional wants to get within 20% of the low. Remember the accumulation pattern. So it's varying up and down and up and down and up and down, and it breaks out of that range. So you want to be in while it's an accumulation pattern. And then you want to get out within 20% of the top, which is, again, the distribution pattern. So that's what you really achieve. That's what you want. You want to catch most of the markup. You don't want to catch every last penny. Again, that's the amateur's thinking. You want to be a professional about it. You want to do your best, but be mature about it. It's investing. It's not, trying to scale something that is impossible to catch the exact bottom or the exact top. So I would say yes. Anytime you can buy any commodity under the cost of production, which is true for both gold and silver in most cases, you're doing well to accumulate it. And that's where we're at right now, and I continue to take a longer-term view. I mean, I think that some of these dollar cost averaging situations where you accumulate, like the professionals do, that's the attitude to take. That way you're not really concerned the day you buy and you put everything you decided to put into the gold market and you're sitting there watching the screen all day, every day. This will drive you crazy. I mean, you can't, some people do it, but you really will drive yourself nuts. You want to take an approach that I need to accumulate precious metals over the next, 6 months, 2 years, whatever. Well, I'm going to do it until I get to this level. Once silver gets above 20, I'm going to stop accumulating, which is what the pros would do. Or 21 or 19. I mean, you can pick the number. I'm just giving you the idea. And this is the way to approach the market in a mature and sophisticated way that people know what they're doing rather than try to pick an exact bottom or a certain exact point in time.
All right. Well, David Morgan, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find you online?
Yeah, one is I think I want to emphasize that we do a podcast. We've been doing it for years. My friend Kerry Lutz set it up for us. So I don't know how to get there, but if you just Google the Morgan Report podcast, you should be able to find it pretty easily on either iTunes or I think it's on the Android platform as well. That would be number one. Number two, I think as this market moves forward, we do have two newsletters, a paid and a free. I would encourage everybody to get on the free list. Just go to themorganreport.com and give us a first name and an email address. And that's only half of the equation. You will get an instant return from our autoresponder that you need to verify. So it's a two-step process. Name and email, and then verify in your email box that you really want our information, which is sometimes there's ads. I'll be honest. We usually advertise twice during the week. But on the weekends, I take time to put together a very comprehensive look at the week from a financial, economic, physical economy perspective, and always end with some comment that's hopefully worthy on the precious metals themselves. So that's something you get for free. It's valuable. Most people find it to be a big time saver. And we're here to save you time and help you make money, preserve wealth, and build wealth for these very trying times.
All right. Well, any last thoughts you'd like to add, and maybe some key price points people should be looking at for maybe the coming weeks going forward in the precious metal markets?
Well, I think if gold got above 1,300, I'd get pretty excited if it stayed there. And I think for silver, it's a tougher market to call, believe me, I know. But I'd say if we got into the 1750 range, it would get me pretty excited. Other than that, I think accumulating is probably the best. And have a longer-term attitude. That's a problem. I coined the phrase, this metals market will scare you out or wear you out. We're definitely in the wear you out phase. I mean, I don't know how many long-term bull precious metals people I've talked to over the last 5 years or so that have basically given up or thrown in the towel or moved on to a different sector. And I guess the last comment I would is to the crypto world out there, which are a lot of young, aggressive people and others. I mean, it's throughout the space, but it's mostly younger people. Consider moving some of that profit into the metals. I mean, again, sell what's dear and buy stuff that's unloved. This is a top opportunity to perhaps cash into something that has stood the test of time. I mean, think about it. Physical metal circumvents the electronic platform, which is something that does pose some concern. I don't want to overemphasize it, but it is something that's real and it's been tangible wealth for thousands of years. You can't say that for the electronic platform.
Once again, David Morgan, thank you so much for joining us today.
My pleasure, Elijah. Thank you.